The Working Capital tab is a standalone tool that helps you understand the company's working capital requirements and how cash moves through the business, and ultimately, how much liquidity the company needs to operate day to day. To get the most accurate analysis, it's best to use monthly balance sheets and include as many periods as possible, ideally 12 to 24 months or more. That gives you enough data to identify seasonality and spot trends in companies' working capital needs over time. To add an additional period, simply click this button and assign the date. Based on the time period of the balance sheets you're entering, monthly, quarterly, or annual, you'll label that here in this drop-down menu. The main inputs for this tab are the company financials, which come from the P&L or income statement, and the current assets and current liabilities, which are items that come from the balance sheet. The first column, shaded here in gray, shows the outputs. These numbers are automatically calculated based on the periods you enter to the right. You can change the aggregation method to view the average for the full period or trailing 12 months if you've entered more than 12 months of data. You can also get a snapshot of what the numbers look like in the most recent period and what they look like in the period where net working capital is at its highest and its lowest. By default, the current assets include accounts receivable, inventory, prepaid expenses, and work in progress. The current liabilities include accounts payable, accrued payable and benefits, and the liabilities portion of the work in progress. You can add additional current assets or current liabilities by simply clicking on the Add Item button and entering in those details. Once these values are entered, the net working capital row automatically calculates. When your net working capital row populates, so will the next two sections, which will show you how efficiently the business converts working capital into liquidity and how effectively it manages short-term obligations. Starting with the liquidity and solvency metrics, these provide a snapshot of the company's near-term financial health. The first metric, net working capital as a percent of revenue, shows how much working capital the business needs to support each dollar of sales. It's a good indicator of capital efficiency. The lower the percentage, the less cash is tied up to generate revenue. Current ratio measures how well the business can cover its short-term liabilities using its current assets. A ratio above 1.0 typically means the company has enough liquidity to meet upcoming obligations without issues, though the ideal range will vary depending on the industry. The quick ratio is a more conservative version of that same concept. It excludes less liquid items, like inventory, giving you a clearer sense of how quickly the company could cover its bills using only its most liquid assets, such as accounts receivable. And if you ever need a deeper explanation on any of these concepts, you could always click on any term to reveal a slide out with an explanation of how it works in the model, why it's important, relevant tips, and frequently asked questions. Together, these three metrics provide a quick, high-level view of the company's liquidity position, essentially its breathing room to operate day to day. Below that, you'll find the working capital efficiency metrics, which show how quickly cash moves through the operating cycle. DSO shows how long it takes to collect payments from customers. DIO measures how long inventory sits before it's sold. DPO tracks how long the company takes to pay its vendors. These three metrics combine to form the cash conversion cycle, which tells you how many days it takes for a dollar to leave the business and return as collected cash. A shorter cash conversion cycle generally indicates the company is managing its cash flows efficiently, meaning it's collecting faster, turning over inventory quickly, or stretching payables strategically. Now, tying all this together, if you look back up, you'll see a change in net working capital rows. These rows show how working capital moves from one period to the next, both in absolute dollars and as a percentage. And it's where seasonality starts to show up. It's worth noting something that can feel a little counterintuitive with these rows. Normally, in financial analysis, black numbers typically indicate something good, while red numbers usually signal something bad. But here, it's reversed when you think in terms of cash impact. The black values in these rows indicate net working capital increase, meaning more cash is tied up in operations. Red values indicate net working capital decrease, meaning cash has been freed up, which is a positive thing for the business. Now, take a look at how this plays out in this example. If you look at the beginning of the year, from February through April, net working capital steadily declines, dropping from roughly $201,000 in February to about $185,000 by April. You can see that reflected by the red values and the change in net working capital rows. That drop signals improved liquidity, meaning the business has freed up cash. And here's why. Even though both current assets and current liabilities come down over this period, current assets decline faster. Specifically, accounts receivable and inventory fall more sharply than accounts payable and accrued payroll and benefits, which reduces the net amount of cash tied up in operations. Then, as you shift later in the year, from April through September, net working capital increases from about $185,000 to roughly $223,000, shown here by a series of black values. As you can see, accounts receivable rises across those months, as do inventory costs. Accounts payable and accrued payroll also increase, but not at the same pace, so the business needs more cash to fund operations, meaning working capital is absorbing cash until receivables are collected or inventory turns. So, to summarize that, when accounts receivable and inventory rise faster than accounts payable, net working capital increases, meaning cash is being used. When accounts receivable and inventory come down, or accounts payable rises, net working capital decreases, meaning cash is being freed. That's why it's so important to have 12 to 24 months or more of balance sheet data. It lets you see the natural rhythm of working capital, periods where working capital builds up to support business activities, and periods where it comes down as collections are made and inventory normalizes. By looking at these change in net working capital rows, alongside your working capital efficiency and liquidity metrics, you get the complete picture. Not just the month you're in, but how and when cash moves through the business. Now, let's look at the left sidebar. This is where you'll see an estimate of how much working capital the business will need on day one, and assess whether there's a shortfall or surplus based on how much working capital the seller is leaving behind. Starting at the top, you'll see working capital required at closing. This number estimates how much working capital the business needs on day one to cover its fixed, non-discretionary expenses, things like payroll, rent, and insurance. It represents the cash the company needs to stay operational during the timing gap between delivering its product or service and actually getting paid. It's calculated using the company's fixed operating expenses and cash conversion cycle, essentially, how long it takes cash to make a full loop through the business. While the formula uses historical data, the result is forward-looking. a practical estimate of how much liquidity you'll need post-close to keep the lights on and payroll running smoothly. Below that is the seller-provided working capital section. These are manual inputs. They represent what the seller is agreeing to leave in the business as part of the transaction. That might include accounts receivable, inventory, prepaid expenses, or other short-term assets. Even though you see a field here for cash, cash is typically not included when a seller leaves behind working capital, as most deals are done on a cash-free, debt-free basis. If cash is part of your negotiation, it often comes in the form of a reduction in the purchase price, not actual cash in the bank. And finally, at the bottom, you'll see the buyer's working capital section, where the model calculates whether you have a shortfall or a surplus on day one. If this number is black and positive, that indicates a shortfall, meaning the business doesn't have enough working capital to support operations at close. In that case, you'll need to take one or a combination of the following three actions. One, you'll need to bring additional equity to the deal. Two, you'll need to negotiate for the seller to lead more working capital in the business. Or three, you'll need to finance it with your lender, either as part of the term loan or a line of credit. If the number is red and negative, that indicates a surplus, meaning the business has more than enough working capital relative to what's required. That's a positive sign from a liquidity standpoint and can sometimes strengthen your position during final diligence or credit committee discussions with your lender. Together, these metrics give you a clear picture of how efficiently cash moves through the business, when and how cash is tied up, when it's released, and what level of liquidity you'll need in order to keep operations running smoothly post-close.